the distribution becomes critical. And in that case, the company which distributes will have control. So the relevant activity also could be multiple, it cannot be one. Now, if there are many companies controlling those activities, you have to see which is the more relevant activity. So, if the ice cream is very unique, where just because of production, just because of the quality of the ice cream, people are going to go for that particular ice cream. Whether you do marketing or whether you don't do marketing, the ice cream is very innovative as compared to other players. Then it is a manufacturing, right? But if it's other way around, ice cream is general and major role will be played by the marketing, how it is marketed, how it is being advertised. In that case, the distribution will become more relevant activity, and the company which controls that activity will have the control. Right. So 60-40 would be just relevant as a starting point. But finally, you have to see who is making decisions, who is having control. So it might happen that the entity with 40% is able to direct the main important activities. In that case, the 40% entity, the entity which owns 40%, will do full consolidation.
But if it is actually joint control of 60-40, say for example, the vote is also 60-40.
Right.
And the voting rights are 60-40.
Which is fine.
Then it should be joint.
No. So the shareholding is just a one criteria. But that is not the criteria for 1-1-1 or 1-1-0. The main criteria is who is the decision maker, what are the relevant activities, and who has the control over the relevant activities. So it might happen, as I told you, with 40%, the company is enjoying, the company is actually having power of those decision making. In that case, the entity with 40% will consolidate full. Now what will happen is, it will consolidate full revenue, it will consolidate full expenses, and non-controlling interest in that case would be 60%. Right.
But practically it will be very difficult.
No, it happens. So as of now we are saying it's difficult because we have not seen this concept for a long time. These concepts are very new.
Understand actually which entity is controlling this, because
so that's an indirect. Right. The entire 1-1-0, the concept is it's completely moving, not completely, but many times it's moving out of the actual shareholding. So shareholding could be 51, 75, 80, but you don't have to see those equity holding. You have to see what are the relevant activities. I'm currently actually on one particular topic, a very big corporate. 3 Big 4 were involved. One Big 4 was existing auditor, the other Big 4 was incoming auditor, and the third Big 4 was the auditor of the holding company. And the 3 Big 4 had a discussion for almost 9 months to conclude on a topic. So these topics are actually quite difficult at times, because there will be many permutation, combination, there is a control, what are the relevant activities, what do you do, this, that. So it's all very subjective. Under Indian GAAP it was very simple, 51% consolidation. Under this, the holding is just one factor, but finally it is the control of the relevant activities, right? So who has the control? Who has the right of key management personnel? So all these factors, who approves the business plan, if the other party has control over the capex also. So all these factors actually would be looked at combinedly.
So if there is 60% control, forget shareholding, there is 60% control and 40% by other.
No, but which is 60% control, 60% is controlled by share.
Even if you function by your other things, other criteria,
so that will give you answer of control or no control. That will not be quantitative. Then you will say whether there is control or not control. Once you establish there is control, then how much to, so you will consolidate full, but how much to allocate to minority interest, then your percentage will come of how much percentage you actually own share. So once you have control, you will consolidate full. And after that, how much to allocate to minority interest, that time what your percentage will be relevant or coming through. So for example, with 40%, if you see there is a control to the relevant activities, you will consolidate full. And then out of consolidating full, out of that 60% will go to non-controlling interest. So it will look little absurd or little weird that out of 100 you are allocating 60 to non-controlling interest.
You have to be identify which is the joint venture and which is subject.
No, so this is a simple example, but in practical life you will have, so it might take time, so it might be subjective, but you will be able to assess the control. Yeah.
Division that goes
though it's more than 50%, it will account as an associate. Because the whole concept of holding company, subsidiary company, associate accounting, everything has more relevance. I wouldn't say more relevance, but has a limited relevance with the equity holding. You have to say the definition of control. Irrespective of the holding, if you are able to establish there is a control, you will consolidate. Irrespective of the holding, you will consolidate. And the remaining will go to non-controlling companies.
How do you sense the word control?
At each level.
At each level.
At each level. So generally, I mean, typically I have seen in 90% of the cases, the definition of control will remain same and will tend, generally will go by percentage holding. The control definition would be relevant in 10% of cases, but those 10% of cases will take 90% of your time. Right? So, if there is a side agreement with the promoter, or if there is a PE, now PE would have invested, private equity, sorry, when I say PE, private equity player has invested. Private equity player has probably would have invested only 25%. But by putting 25%, it would have taken many rights under the investment agreement. You cannot have key management personnel you have to appoint, you have to take my approval. If you invest beyond X amount, you have to take my approval. If you do changing the price of the product, you have to take my approval. So in those cases, the definition of control may trigger. I am not saying it will always trigger, but you have to see case by case.
In case any financial institution giving a big borrowing, is such a control and having some control by way of agreement, in that case also you can take.
Yes.
Say for example,
Yeah.
giving to any expenditure.
It can. Just to give theoretically, and theoretically could be actually in real life scenario also. So you have a subsidiary company, holding company has got a subsidiary company. Holding company is 100% owner of the subsidiary company. Say 1 crore is invested. Subsidiary company goes to a banker, gets 1000 crore as a loan. Right? Now when the banker is giving 1000 crore as a loan against just 1 crore of equity, when the capital contribution by the parent company is only 1 crore, where the amount invested by the banker as a loan is 1000 crore, definitely it is taking more of risk, lot of risk. And to protect the risk, it will have a side agreement, where under the side agreement it will lay down a condition. You can't do this, you can't do this, you can't do this. If you do this, you take my approval. If you do this, bank loan.
Board of directors, you will, or say PE or something like that.
Yeah, many conditions. Right? In those cases, you have to see whether there is a control or not. And most likely, if the company is contributing so much as a loan against very thin capital, it means all the relevant activities would be covered by the banker. In that case, the banker will consolidate with 100% minority interest.
And that company, although by equity would be
Associate.
Associate.
Right.
A simple example of the ice cream company. Suppose in a subsidiary, I don't have experience of ice cream, I hold a 60%. The 40% is with some brand, Baskin Robbins or Hemal or whatever. So I am going to be controlled more on quality, methods and all that. Despite 40%, they have the control and I will with 60%.
Yeah.
Not
So there is a guidance on franchise and franchise relationship. We'll cover that. Just park that question. Very valid question.
Theoretical treatment power does not arise from protective right.
Okay.
So whatever.
Just park that question. I'll cover that.
So in that case, when
Yeah. So I answered the question and just park the question. There is a detailed slide on that. What is protective right and what is participative right? I'll cover.
I think the mention the scope is widely now opened up. So being an auditor, of course, it's a common question. In Indian GAAP, it was very easy to judge whether it is a subsidy or not as far as consolidation is concerned. But now, how we are going to judge whether these items should occur? If we have to, for example, if we take one example of investment, we'll go through that investment and the current investment schedule, each and every then transaction parties, how they
So I completely agree with you. Under IND-AS it was very easy because it was just by equity pickup. So if you had 50%, you had control. Do consolidation, forget it.
investment schedule.
Exactly. Now that is not enough.
Yes.
Now what you have to do is you have to ask the management to sign the agreement separately other than shareholder agreement. If there is a side agreement, please give us the side agreement. Please fit the side agreement. What are the powers given to the investor under the side agreement? Whether those powers constitute control. If yes, the consideration can change. So it's a lot of work now.
A lot of reading or
Yeah.
Even only
Lot of
just
it, lot of
taking
it.
an MRI is not
Not enough.
enough. You have to go in that.
No, as I told you, the one example which I am currently running, we have concluded now, but otherwise it took 9 months for 3 big 4 to come together and reach a conclusion. So earlier there was a fight between one, anyway, there was an opinion by auditor, management did not agree because management wanted something else, right? The incoming auditor had a different opinion, the holding company auditor has a different opinion. So this kind of, when the standards are laid down on a principle base, when there is no rule, your interpretation and my interpretation can be different, right? But if you do it thoroughly, your judgment cannot be wrong. So again, why initially why the Big Four had different opinion? Because all the facts were not clearly understood. But once you have all the facts on the table, then I don't think so any person who is making decision can have a different opinion.
So you can have a situation where say 60-40 investment is there, and both the holding company may consider or both will say I don't have control, I don't know.
No, so both companies may consider it to be only have a rights.
If auditors are different and the management is different, they will say I don't have control. Both will say.
No, so then I would say okay. So then I would say one of the assessment is wrong because
Assessment, when this thing practically can happen, that one particular company, two people are consolidating, or nobody wants to consolidate that company, so nobody wants that check.
yeah, so it should not happen because the control definition is now very clear. But if your judgment is wrong, if you make an error, then what you say is right, it can happen. But otherwise it cannot happen. If your assessment is right, it cannot happen. Second example, A and B form an industry to develop and market a medical product. A is responsible for developing and obtaining regulatory approval. Once the approval is received, B will manufacture and market it. Right? So there are two phases to it, right? One is the development of the product, and second is manufacturing and marketing. Right? Development is at A's discretion, manufacturing and marketing is at B's discretion. Right? The question is who controls? Again, what is the relevant activity? So we have to assess the situation. So there is no yes or no answer, there is no A or B answer. You will have to see what is the relevant activity, who has the control over the relevant activity, right? So just to give you an example, take an example of pharma company when there are no research involved. So if you do basic research, the basic research itself costs minimum 9 to 10 years. What we call basic research, and then the IND-AS is just basically 2 or 3 years data. But if you do basic research, it is like 9 years period minimum. And investment could be as high as minimum could be 1,000 crore, right? So a lot of activities goes in the development phase. So if that is the main activity, then definitely A will consolidate. However, if your assessment is the research is very basic, it's not like very advanced research. The research can be completed at a very minimal cost within 15 months time. Marketing and manufacturing would be relevant, a critical one. Then the company B will consolidate.
Can it happen first 10 years A will consolidate it, 11 to 20th or?
It can happen. It can happen. So for example, after regulatory approval, until you get the regulatory approval, it's basically company A is playing main role. But after getting the approval, B's role becomes main. So relevant activities might change. And A may stop consolidation after getting the approval, and B may start consolidating. But again, bottom line will not change. It's only the top line expenses which will get changed. The bottom line, which is the profit number, in both the cases will be same. Right? Okay, this is how actually I will conclude. Another example. Two investors C and D form an investee E to acquire, dispose and manage investment property portfolio. Investor C is responsible for acquisition and disposal of the property, and investor D is responsible for the management of the portfolio. Now there is a fixed return that IRR is expected, and if the company is not able to achieve that IRR, the companies would be held responsible. Who has the control? Again, in this case, you will see what is the relevant activity. If the major activity, if you see, is buying and selling of property, then it is that company who has controlled buying and selling of property, or the company who makes the decision of buying and selling the property will consolidate. However, if you see, buying and selling is just one time, but maintaining it, giving on rent is the major activity, then it is the other company who has that control will consolidate. And it will depend upon the circumstances. So if IRR is fixed at a very high rate, every year, say 20% IRR is expected, right? then it will have a different ball game as compared to if the IRR rate expected is only 3 or 4%. If IRR expected is only 4% by the investor, then 4% can be achieved even by giving property on rent. So in that case, giving on rent will become significant activity or major activity, right? But if the IRR achieved target is kept very high at say 20%, then it cannot be achieved by just giving on rent. Then the company will definitely try to buy and sell property to make profit. In that case, the company who has got decision making power on buying and selling will have power in control. Okay. Power arises from voting right, potential voting right. Potential voting right we have covered, like convertible debentures and all. Contractual arrangement. So you have a contract, to appoint key management personnel. You have a contract to decide on the selling price. You have a contract to kind of direct a company where to buy, where to sell. If the decisions making are all controlled by you, even though your holding may not be 51%, but still, by way of this agreement, you will consolidate. Okay. The third relation which I would like to highlight now, the rights have to be participative right and not protective right. In fact, what you raised, what is the difference between participative right and protective right? So whenever we say we have rights, we have power, the powers have to be actually participative and not protective. Now what is the difference? The difference is the protective rights are held by the investor only to protect his investment, not to make the decision. The objective of rights is not to take active part in decision making, right? So, for example, if the PE is the private equity is investing in a company where few of the rights are taken by the private equity just to protect its interest, right? So, even if I am taking non-controlling interest, I am not taking controlling interest, I am taking say 30%, but I am putting money for 30%, right? And I am not mad to give just 30% like this, right? So I have some power to ensure my 30% is protected. So what I will do, I will say, okay, I am giving 30%, control is with you, that's fine. But you can't sell your plant without my approval. Right? You can't venture into something new business, right? So as of now, you are an e-commerce company. I am investing 25% now. Assuming that you are an e-commerce company now and you will continue as an e-commerce company in future. If you want to start retail operations, you need to take my approval, right? So those rights are protective rights. Those are not participative rights. Standard very clearly disregards or basically differentiates between participative and protective right. So if the rights are only protective, it does not give control. For getting the control, the rights have to be participative. Fine?
Generally, protective rights will be restriction on the joint venture partner to do certain things.
Right.
Generally, no, you cannot do this, cannot do it. Right. Restriction on the other part.
Right.
While participation is your own right.
Right. So, what is in this right? The only thing is, at times, it's a grey area. And it's a grey area when in the circumstances where the investment holding by P is very close to control stage. So, if the P is investing say 40-45%, then the rights enjoyed by the P would be different as compared to what it is putting the rights with 20% investment. So in 20% investment, it will say, don't start a new business without my approval, don't sell a plant without my approval. But once the P puts 45%, then it will have no conditions, don't appoint or appoint CEO with my approval, make your business plan, take my approval. So once you have those rights, then it becomes very subjective. Then you have to see, whether these rights are actually only protective or participative. At times, the assessment could be different. Again, plan or approval for capex. Now, capex approval is one concept, right? But if the capex approval of 10 crore, right, may be protective for a software company, because in software company the main investment is into human resources. The fixed asset would be very limited, it's basically furniture and computer. But the 10 crore investment could be very minor or could be very low for a manufacturing company. So when you have a condition of 10 crore, same amount, depending upon the industry, it could be either participative or protective. And these are actually, you have to basically see the whole situation, all conditions together. So you have the right to capex. If you have more and more conditions, then it could trigger control.
In case of FDI, the 49% allowed in the sector. But the case, around 49% the rights by the foreign will be decided in control. And consequently, the 50% party will not consolidate.
Right. So the example which I gave you, that 3 people were involved, exactly was this case, where FDI was restricted, and by way of an agreement, the foreign party had few rights. Now in this case, the holding of the foreign company would be 26% or 49%. But because of the side agreement, the foreign company will have many rights. The whole question was whether the foreign party is controlling or the Indian party is controlling.
Then this may also according to RBI violation.
Yeah. So you are all getting the points of the case what I am writing. But again, so how the RBI looks, whether the RBI will look at accounting or RBI, IRDA, or mutual sector is also very big challenge. Especially after India Auditor Control definition, the IRDA wants all the insurance company to be owned and controlled by Indian promoters. Whereas practically, because of the agreement, with the foreign party, the agreement gives many rights to a foreign company or foreign party on the operations of the company. So whether it is India Auditor Control or whether it is controlled under IND-AS by the foreign party, it's all different. So different in the sense it's kind of assessment would be kind of easy to make, but how the regulatory authority take a view, whether they will go by accounting view or whether they will go by other view. That's all. In fact, in one of the cases, we will take guidance from the regulatory authority itself to see, what is their guidance, how they are looking at it, whether if you do accounting as per Indian GAAP or IND-AS, can there be some kind of action from the regulatory authority? Right. So all this actually wait for a very long time.
You may have different sets of financial also. Like IND-AS compliant, financial, and those parties might, those foreign companies might be consolidating their things. You may have to prepare under IFRS also.
Yeah, it could, and in fact, so if it's under IFRS, then the assessment would be same. But if under US GAAP, still, the chances are actually it will be same. But if the gaps are totally different, like for example Indian GAAP, so other companies having say some local GAAP, where again the entire trust is on shareholding, then assessment could be different. So your holding company is in India, and the subsidiary company is outside India.
So within India, say MBS.
Okay, yeah. So I agree. So now this will typically happen if the holding company is preparing accounts as per IND-AS, subsidiary company will get covered. But now only thing is, if the subsidiary company is into a different business, so like NBFC, or not NBFC, but say finance company or banking company, then I agree. Because for banking finance company, the roadmap is different. Whereas for the company, the holding company is listed company, the guideline would be different. So for that, then the banking company or that insurance company will have to prepare IND-AS financial only for consolidation. And for its own account, it will implement IND-AS 2 years down the line. So there are cases, So as of now, for 2 or 3 years, it will continue under Indian GAAP or under whatever regulations. But for